Right now, the CRA does not need to audit you manually anymore. An algorithm can flag your home, your bank account, and your tax return in seconds. And if that happens, you will not get a warning. You will get a bill. Most Canadian homeowners assume that a tax audit begins when a government employee decides to look at them. That assumption is wrong. The decision is made by a system, a data system that has been assembling a picture of your financial life from sources you never consented to for longer than you probably realize. And in 2026, that system has reached a level of capability that changes everything about how Canadian homeowners need to think about their exposure. We have spent the past several weeks pulling threads, and at the time they did not look connected. The principal residence exemption audit, the retroactive reassessment on sales from 3 years ago, the renovation receipt review, the TFSA trading assessment, the Airbnb platform reporting requirement, the HST self-supply rule. Each of these appeared to be a separate enforcement initiative, a different department, a different provision, a different type of homeowner targeted for a different reason. They are not separate. They have never been separate. They are all outputs of the same input. One coordinated data infrastructure that most Canadians have never been told exists. Welcome back to Canada Property Watch. This is part 5 of the Exit Tax series, and it is the investigation that every previous part of this series has been building toward. If you have not watched parts 1 through 4, we strongly recommend doing so because what we are about to show you will make significantly more sense with that context. But if this is the first time you have found this channel, here is the summary you need. The Canada Revenue Agency has been conducting an escalating enforcement campaign against Canadian homeowners that has included the denial of principal residence exemptions, the retroactive reassessment of home sales from 2021 and 2022, the auditing of renovation receipts and adjusted cost-based claims, the reclassification of TFSA investment income as taxable business income, and the assessment of HST under the self-supply rule against homeowners who substantially renovated their properties. Each of these enforcement mechanisms targets a different provision of Canadian tax law, but all of them are being identified and selected for audit through the same underlying data system. And in a moment, we are going to show you the exact pattern that turns this data into a 6-figure tax bill for homeowners who believed they had done nothing wrong. Let us start with the foundation. FINTRAC, the Financial Transactions and Reports Analysis Centre of Canada, is Canada's financial intelligence unit. It was established in 2000 under the Proceeds of Crime Money Laundering and Terrorist Financing Act. Its mandate is to receive, analyze, and disclose financial intelligence to law enforcement and government agencies. Every year, FINTRAC's database receives approximately 20 million transactional reports from approximately 31,000 sources across the Canadian economy. Banks, credit unions, real estate brokers and sales representatives, mortgage brokers and lenders, life insurance companies, money services businesses, title insurers. Here's what most people miss. These entities are not reporting to FINTRAC voluntarily. They are legally required to do so. And the intelligence FINTRAC generates from those 20 million annual reports is disclosed to government agencies, including, explicitly and by statute, the Canada Revenue Agency. When you buy a home, you think it is a private transaction between you and the seller. In reality, 3 separate entities, your real estate broker, your mortgage lender, and your title insurer, are each legally required to file reports about that transaction to a federal financial intelligence database. Before your keys are even cut, you did not opt into this system. You entered it the moment you participated in the transaction. This is the first layer of the architecture. And as of October 1st, 2025, new FINTRAC requirements came into force that extended these obligations significantly. Real estate brokers and sales representatives are now required to verify the identity of any unrepresented party to a real estate transaction, closing what FINTRAC described as a long-standing gap in anti-money laundering oversight. Title insurers are now regulated as reporting entities for the first time, meaning that the title insurance covering your property transaction is now itself a mandatory source of reports to FINTRAC. This is already happening. These changes mean that every participant in a residential real estate transaction in Canada is now a mandatory reporter to a federal financial intelligence database that shares its intelligence directly with the Canada Revenue Agency. The second layer is the bank. Your mortgage lender, your checking account institution, your investment broker, your credit union, all of them are reporting entities under the Proceeds of Crime Act. They report large cash transactions, suspicious transactions, and electronic funds transfers to FINTRAC as a matter of legal obligation. But their obligations to the CRA extend beyond FINTRAC reporting. Your bank reports your RRSP and RRIF contributions and withdrawals to the CRA annually. It reports your TFSA contributions and withdrawals to the CRA annually. It reports your interest income to the CRA annually. It is required to respond to formal production requirements from the CRA that can compel it to provide complete transaction records for any account you hold. And here is the part that changed in 2025, and this is where it gets dangerous. In November 2025, FINTRAC published new guidance enabling private-to-private information sharing between reporting entities. Under an approved code of practice, a bank can now share your personal financial information with another bank, an insurance company, or a real estate firm, without your knowledge or consent, which means the pattern does not need to exist in one place anymore. It can be assembled across institutions. Your mortgage lender sees one piece. Your investment broker sees another. Your insurance company sees a third. The system connects them. And at current CRA interest rates, but any amount owing from a reassessment can grow by thousands of dollars per year before you receive a single piece of correspondence. The third layer is the municipal government. Every building permit you apply for is a municipal record. Every property assessment is a municipal record. Every bylaw enforcement action against your property is a municipal record. Every change in the assessed use of your property is a municipal record. The Canada Revenue Agency has access to provincial land registry databases, showing the ownership history of every property in Canada. It cross-references those records against its own taxpayer files. When a taxpayer's address history is inconsistent with property ownership records, the discrepancy is flagged. When a building permit shows a substantial renovation project, but the corresponding tax return shows no significant renovation expense disclosures, the inconsistency is flagged. Consider a homeowner in Mississauga who spent $180,000 renovating a property over 18 months, paid a significant portion of the work in cash to contractors who were the only ones available during the backlog years, and then sold the property for a $340,000 gain. The building permit existed. The MLS listing showed a fully renovated home. The adjusted cost base on the tax return reflected only the formally documented portion of the renovation spend. That gap between the permit record, the listing photographs, and the declared cost base is exactly the pattern the system is designed to find. And that gap can translate into a six-figure reassessment, even if the renovation actually happened. A file like that does not require a human to notice it. The algorithm notices it. This is not a manual process. It is an automated data matching system that runs continuously, generates referrals to audit teams, and does not require a human being to make an initial judgment. The algorithm makes the selection. The audit team receives the referral. The letter goes out. The fourth layer is the real estate platform itself. And this is where it gets extraordinary. A photograph of your renovated kitchen is not just a photograph anymore. It is data. It can be scanned, categorized, and compared against your permit records and tax filings automatically. I'm using image recognition systems that can identify the scope and quality of renovation work from visual evidence alone. A human does not need to look at your listing. The system already has. MLS listing data, including property photographs, renovation disclosures, and pricing history, is publicly accessible and has been systematically indexed. Realtor.ca, Zillow Canada, and individual brokerage websites make this data available to any party with internet access, including the automated systems operated by CRA compliance teams. The listing you created when you sold your home is a permanent public record. The professional photographs of your renovated kitchen, your finished basement, your new bathrooms have been indexed. They have been processed, and they have been cross-referenced against your permit records and your tax filings. At this point, this stops being about tax rules. This becomes a pattern recognition system, one that does not sleep, does not take holidays, and does not need reasonable grounds to flag your file. It needs a gap, and if a gap exists between your data and your declaration, the system will find it. Now let us connect this infrastructure to the specific enforcement mechanisms we have documented throughout this series. In part 1, we showed you how the CRA denies the principal residence exemption when the evidence suggests the property was not genuinely your ordinary place of residence. The evidence the agency uses, credit card transaction geography, employer payroll address, social media location data, utility consumption records, comes from a combination of bank reporting, FINTRAC intelligence, and the agency's own data matching systems. Once no single source provides the complete picture, the architecture assembles it from multiple feeds simultaneously. The system does not catch you when you make the mistake. It catches you years later when it has the full picture. In part 2, we showed you how the CRA reaches back into transactions from 2021 and 2022 using the 3-year normal reassessment window. The files selected for reassessment are not chosen randomly. They are identified by a risk-based selection model that cross-references MLS sale price data against original purchase price against comparable market appreciation for the period, and sale price against permit and renovation disclosure records. A homeowner who bought in 2019 for $620,000, renovated without full documentation, and sold in 2022 for $1,050,000. When market average appreciation for that period and location was $180,000, is presenting a pattern the system is specifically calibrated to identify. And this is where most people get it wrong. They believe the gain was the market. The system believes the gap was the renovation. The reassessment follows. In part 3, we showed you how the renovation receipt review works. The trigger is the gap between the permit record, which documents the formal scope and estimated value of renovation work, and the adjusted cost-based claim in the tax return, which documents what the taxpayer says they spent. When those numbers are inconsistent, and inconsistency of more than 20 to 30% appears to be a threshold that generates flags, the system escalates the file. The flag generates a referral. The referral generates an information request. The information request, if it reveals undocumented cash payments, generates the reassessment, and then the interest begins. Not from the date you received the letter, but retroactively from the date the reassessment determines you owed the amount. In part 4, we showed you how TFSA trading records are obtained from financial institutions under formal production requirements and used to assess whether the account was operating as a business. The production requirement goes to the financial institution directly. The account holder is not informed. The records are produced. A TFSA holder who executed more than 250 transactions in a single year, consistently traded options and volatile securities, and generated returns significantly above passive market performance. That pattern is the profile the assessment criteria target. And once the account is classified as a business, the entire tax-free assumption disappears. Every dollar of gain becomes taxable. Every year of compounding becomes a liability. In the HST trap investigation, we showed you how MLS listing photographs are cross-referenced against permit records. The photograph of your renovated kitchen that you uploaded to a real estate website was indexed and accessible before you ever received a letter from the CRA. It was part of the evidence file before you knew you had an exposure. What this architecture means practically for every Canadian homeowner in 2026 is that the question is not whether the government can see your financial activity. It can. The question is whether the picture assembled from the data sources it has access to is consistent with what you have declared on your tax returns. When those two pictures match, you are invisible to the audit selection system. When they do not match, the inconsistency is flagged and the process begins. This is the first time in Canadian history where your entire financial life, your mortgage, your renovation spend, your rental income, your investment returns, your property sale, can be cross-verified against itself and against your tax declarations without your involvement, without your knowledge, and without any individual at the CRA making a discretionary decision to look at you. And it is already operational. The homeowners who are most exposed in 2026 are not the homeowners who deliberately set out to defraud the tax system. Those people exist, but they are a small minority of the files the CRA is currently working. The homeowners who are most exposed are the ones who made decisions that were reasonable and legal at the time, without understanding the full regulatory picture that would apply to those decisions years later. The investor who rented a basement for cash income to help carry the mortgage during difficult years. The homeowner who renovated gradually and paid contractors in cash because the formal economy was backlogged and the cash economy was the only economy that could get the work done. The TFSA holder who spent 2 years actively managing their savings because the markets were volatile and the opportunities seemed real. The homeowner who sold their renovated property and believed the principal residence exemption covered the entire gain because nobody had explained when it would not. None of these people broke any rule knowing they were breaking it. The system changed around them while they were making reasonable decisions with the information they had. And the architecture documented in this investigation exists specifically to find the gap between what they declared and what the data says actually happened. As of October 2025, every party to every real estate transaction in Canada is being identified and reported. As of November 2025, Canadian financial institutions can share your personal financial information with each other without your knowledge or consent. As of 2025, Airbnb and other short-term rental platforms are reporting all Canadian host earnings directly to the CRA annually. As of 2026, title insurers are mandatory reporters to FINTRAC for the first time. Each of these changes individually would be unremarkable. Together, they represent the completion of a surveillance infrastructure that covers every financially significant decision a Canadian homeowner can make. From the mortgage application to the renovation permit to the rental income to the eventual sale. The system does not announce itself. It does not ask your permission. It does not send a warning. And by the time the letter arrives, the decision about your file has already been made. The letter arrives by registered mail, requiring your signature on an otherwise ordinary afternoon. The letter that starts the clock. The letter that begins the interest accrual, retroactively from the date of the reassessment, not from the date of your signature. The letter that initiates a process that the investigations in this series have documented in detail. Understanding the infrastructure that generates that letter is not a reason to panic. It is a reason to be precise, to keep receipts, to file the right forms on time, to understand the rules that apply before you make the decision, not after the letter arrives. To consult professionals with the specific expertise required for the specific decision you face. The gap between what you thought you understood about your rights and obligations and what the system actually requires is where the six-figure assessments are being generated right now, and that gap is closing faster than most homeowners realize. Subscribe to Canada Property Watch right now and enable your notifications. We will continue tracking the system as it evolves, as new data sharing frameworks are implemented, as new automated systems are deployed, as new provisions come into force. The fine print that generated every investigation in this series is still being written. We will read every document so you do not have to, because by the time you realize you were in the system, you have been in it for years.